Welcome to Benny and the Squirrel. We have a special data center focus since all anyone wants to talk about is data centers and AI CapEx these days. I had the pleasure to be introduced to Ameesh 2 weeks ago, and since then I've had a lot of conversations with him. Ameesh Agarwal, the CIO of Upland Capital or Asset Management. He is a guy who was in alternative assets and credit and structuring, and then got into data centers and now underwrites data centers. And we are going to explore the space a little bit. Welcome to Benny and the Squirrel, Ameesh.
Hey, Benny.
Welcome, Ameesh.
Hey, Squirrel.
So, Ameesh, I think just to give our viewers a background of who you are and your background, can you just give us a little 20-second bio of what your firm is, how you guys got into investing in data centers, and what got you interested in the space?
So Upland historically has been an investor in alternative assets, primarily opportunistic credit in real estate across geographies. And, we're bottom-up investors looking for a margin of safety across our investments. And, investing in real estate and other alternative assets, I think data centers was an organic segue, given the demand for capital, which outpaced the supply of capital. And so it created an opportunity. And fortunately, with the check sizes getting substantially larger, we had the benefit through our LP base, primarily insurance companies and security firms, which had an appetite to invest in the sector through their infrastructure arm. And, when you look at the mechanics of how you look at investing in a data center, which they're not too far from how we look at an alternative asset. So it was kind of an organic segue driven by, a mismatch between demand and supply of capital and where we could find yield and solve for a good risk-adjusted return. And that's
So you just saw an opportunity, and I guess let me pull this up, but I feel like this chart probably helped, right? That's the primary driver of the data center boom, if you will.
Yeah, I mean, it's basically the whole thesis about, you had these frontier AI labs with Anthropic and OpenAI, previously with GPT, and people had their aha moment in 2023, and since then you had a pretty rapid diffusion, and then there was this concept of country of geniuses in a data center where it's like the silicon and the hardware and the infrastructure that powers this technology, which is so revolutionary. And yes, given, as pointing back to the scale of what is required in terms of investing in this infrastructure to power this technology and make it accessible to the end user, I think the capital is not for the smaller. The capital required can only be afforded by the larger companies. And yes, they've kind of embraced it. They've been chasing it. They've been trying to extend their presence and their moat in the sector, and the scale of the CapEx is completely unprecedented. And as you know, like you're showing 600 to 2026 estimate. Now we know it's higher because the memory price is going up. It's closer to 800 billion just for the hyperscalers, and you have 1.1 trillion that is proposed by the hyperscalers. And then if you look at recent NVIDIA's earnings call, what they said is 50% is hyperscaler demand. Look forward, 50% is neoclouds and others, right? So the total CapEx in the sector consensus for next year is well north of $1 trillion, and it is truly unprecedented as to where the capital is from. And like,
given that we're a little bit focused on SpaceX at the moment with the upcoming IPO, what kind of share of the pie do you think SpaceX terrestrial, i.e. Colossus 1, Colossus 2 and on, versus their orbital ambitions is in those numbers? Or are we looking at numbers on top of the trillion for them?
I think like when you look at even their own filings, they kind of sort of justify a TAM of 27 trillion, which is almost close to the GDP of the US, right? And they're like, out of that 90% or 93%, whatever it is, comes from AI. But it's like, hey guys, like when you look at their percentage as a frontier lab, Grok, if you qualify that as a frontier lab or XAI, it's like, hey, what percentage of that is actually, what percentage of the market are they actually capturing? And it's like, close to 3 to 4%. So it's kind of like when you talk about Anthropic, you talk about OpenAI, it's a completely different animal. Like I personally, we have Anthropic baked into our enterprise workthroughs, and today, like for me, I feel like it is something that I can't live without. But like I don't know a single person besides Twitter users who use Grok. The question really becomes is like, hey, like is XAI, what is XAI's sort of differentiation or offering in the space? What is their user base, et cetera? And like, I really don't have an answer for that. And when you talk about Colossal and you talk about like the data centers that they're building, when you look at any frontier lab, like which is XAI or which is OpenAI or Anthropic or Mistral or any of those, like they want compute capacity for themselves. Versus Colossal is they're renting GPUs. They have the power, and now they're leasing it out to Anthropic, and Anthropic's paying them 1.5 billion a year, which is 25 billion of the revenue. So essentially, what they're doing through Colossal 1 and Colossal 2 is being like an Iron or a CoreWeave, or what a hyperscaler is doing, right? Like and hyperscalers offer a lot of other services behind the layer 1 of GPUs, and we can get into that. But like to me, that particular play is just like, hey, I have all these GPUs. Let me just provide them to a frontier lab. So like, is XAI a major player in the AI space? I don't think so. Like there's
$2 trillion riding on that being a reality, by the way, Ameesh. So let's see. But I want to get into the weeds of your expertise, which is the math behind the build and the economics of these data centers, because that's really fascinating. And you and Ben have been doing some fantastic number crunching over the past couple of weeks. I know he's been working you hard.
I think it's a pretty exciting industry, and it's an industry that's been around, right? It's been around since the .com era, and it's had its ups and downs, and the scales right now are just significantly different, which is why it's getting all the attention. But it's an industry that's been around. It's an industry which does not work too differently from how you look at a warehouse lease or some of the other long-term leases that are signed in real estate. And the metric that's different is that in real estate you have price per square foot. The defining and the governing metric is price per megawatt. And it's really a game of, hey, like location, right? Where am I located? Am I in downtown Chicago? Am I in Northern Virginia? Am I in Phoenix? Am I in Austin? Or am I just in the middle of nowhere, right? And that really matters, right? Like just like in real estate, it's like, hey, price per square foot in central Manhattan is different from price per square foot somewhere in New Jersey, in the outskirts of New Jersey. It's the same math. Like the metrics are different. It's not about the view. It's about fiber. It's about the meet me rooms. It's about other nodes and networks being around as it relates to latency and other connectivity constraints that these data centers might need to overcome. It's a question of available power. It's a question of reliable power. So when you factor in a lot of those issues, there's a categorization of the markets. So like being in tier 1 markets, downtown Chicago, North Virginia is extremely more valuable and more than even being in downtown Manhattan, So like, so that's location 1. 2 is the cost per power, availability of power, a long-term contract, a power purchase agreement, or an ESA for, call it 15, 20, 30 years, right? And those factors are important. And then you step down and you're like, hey, like that is, and the water, which is required for cooling as you supply power to these GPUs at extremely high densities. And then that's the infrastructure layer, which continues to be constrained, right? Power continues to be a constraint in these major markets. And then as you go down, it's like, hey, who is the person building these data centers? Is it someone who just pivoted overnight because they saw an opportunity in data centers, or is it someone who's been building data centers for the past decade? So that's sponsorship, which is important, which is the same thing in real estate. Hey, like if you're writing a loan to a developer of a condominium, it's like, hey, like has this guy built before? What's his track record? So it's kind of like, and it's a world of have and have nots. Like you have developers you have these companies like Vantage, Aligned, Compass One, who've been doing these for decades, and like phenomenal companies, global portfolios, have relationships with some of the best tenants and have been doing this for years, right? So like, and these guys are guys who've been in the field for the past 10, 15 years. And then there's people who just, somehow happen to be at the right place at the right time, have power, and be like, hey, I'm going to build a data center. And, we see the difference in the underwriting. We see the difference in the sophistication, the know-how between those two spheres. It's a divided world. It's not like, hey, like it is, and which is very similar to any other industry, very similar to real estate. And, once you get, so it's power, location, location, power, developer, sponsor, whatever you want to call it, and fourth is a tenant, right? And it's like, hey, I'm signing a lease. While we tend to finance the sponsor who's developing the data center, so our collateral is the underlying shell and the documents and the lease that is assigned to. So like, while we don't finance the tenant, at the end of the day, the loan is as good as the durability and the longevity of the revenue streams that I can derive from the lease that the sponsor is signing, which is the coverage that we have on the loan. And, like these are long-term leases. These are 10, 15-year leases with, 5 to 10-year extensions. And
okay, let's pause there, right? Yeah. Because these are long-term leases, and the big debate is the useful life of the kit within a data center. And let's start with that, because that presumably is the fulcrum of your underwriting decision.
Correct.
Right?
So absolutely, because the way we look at it is like, when you look at the shell and the power, right? These are extremely valuable commodities. We believe that AI is here to stay. It's gonna penetrate every layer of enterprise, every layer of personal life. And to power the AI, to keep the technology going, you need the power, you need the shell, you need the base level of what I call infrastructure. A good way to look at it is like, hey, like if the steam engine was invented, you needed roads, right? And you needed roads, and whether it was a Mercedes, BMW, whichever car came, whether it was trains or whatever technology flourished, that was up for debate. But you needed the roads, and the roads had a long-term duration and long-term life, which is the way we look at the shell and the power. Now, on top of that stack comes a GPU stack, which is the stack we try to shy away from, because it is a technology stack, and the jury is out on the useful life of that GPU, whether it's 4 years, whether it's 5 years, whether it's 6 years. And the problem that we have is like, hey, when you're underwriting an asset, you underwrite the power, you underwrite, the shell, you underwrite the location. You're like, hey, this power is not going anywhere. North Virginia is not going anywhere. So like, this thing has life. Someone's going to lease it because I have an extremely valuable commodity that I offer in today's economy. But when I look at a shell, how do I underwrite when I look at the chips, it's like, how do we underwrite these chips, which could lose their entire life in 4 years, 5 years, 6 years, or 7 years, right? And then they're probably worth $0. And like a backward looking statement, which says that, hey, the life might be anywhere from 4 to 6 years. And those are the accounting mechanisms that all the hyperscalers seem to be using. They might not be the best representation for a forward looking statement for the next 6 years for a technology that moves so fast. Because like 6 years ago, no one was even talking about it, right? And today, the hottest conversation is GPU. So like that's a layer that we shy away from. And it's kind of like a business that requires which has a life cycle of 6 years, right? That's why we look at the GPU, or 4 years or 5 years or 7 years. It's a CapEx heavy, depreciation heavy industry. And I would say like even the air carrier leasing business has a longer lifespan than that. So this is like a one of a kind, and technology changes at a more rapid pace and not at a smaller pace, and has an accelerated curve of decay of the price. And so given all those challenges, like we've always shied away from GPUs.
Yeah. So, but ultimately though, you can shy away from them as an underwriter of the shell, right? But the business of your sponsor and his tenant is entirely dependent on it. So it's not as though you've absorbed yourself from that risk completely.
Absolutely. So like, which is why I said that tenancy matters, right? Like when you, and even in the credit markets today, or the equity markets, just in the capital markets that are involved in financing this sector, digital infrastructure, the tenants that have fortress balance sheets that are, for example, like the hyperscalers, if they're typically as a sponsor, the sponsor doesn't provide the chips. The sponsor provides the cooling, the sponsor provides the shell. Then the tenant comes in, brings in his chips, servers, racks, and then they sell the compute capacity downstream to frontier labs or enterprise hedge funds, etc. Now, when it comes to the point, is like, hey, we can't insulate ourselves from the risk of the tenant paying the rent for the next 15 years, which makes this business of data center lending or data center development feasible. The question is, can the tenant pay that rent for the next 10, 15 years? So when you look at, Amazon or Google or Microsoft or some of these, the hyperscalers in particular, they have several layers of services that they offer downstream besides just renting compute, besides just renting GPUs. So their revenue per CapEx of GPU is substantially higher than an intermediary, such as a CoreWeave, which just rents GPUs from NVIDIA and takes on leverage and then leases them to the hyperscalers to further provide the service stack. So essentially, the ROI on that business is scary, which the unit economics of buying a GPU, which depreciates in 7 years, are negative. The revenue you generate from leasing those out to a hyperscaler or a frontier lab in 7 years are not enough to pay back the CapEx at your existing weighted average cost of capital, which is the debate that's been on Wall Street for quite a bit of time. But given the abundance of capital available in the market right now, some like companies like CoreWeave have been able to finance their way through some of these build outs. But the question still remains, is that, are these businesses sort of long-term sustainable? And I think,
is there any terminal value for them? Right.
Yeah.
And I've discussed that with Ben at length as well. It's like, we've seen the story before. It's like, hey, with WeWork, right? At one point they were trying to become, or were, New York's largest landlord because they were chasing growth at any cost. What they essentially were doing is like, hey, like we're leasing office space, 10 floors of an office building, and then we're subleasing them to like 1,000 people. And that's all that business model was. However, what they were paying for the lease, net of expenses, was more than what they were generating, subleasing the space to the tenants. And they had this whole pitch around them that we're a software company, and that time community was a big word. And that around that buzzword, there is tens of billions of dollars. And they got away with it. And they kept going. Today with CoreWeave, it's like, hey, we're a software company, or we have this more, but none of their software is proprietary. Like it's built on open source.
They're kind of, they style themselves as systems integrators, right?
Right.
We can make this stuff work more efficiently for you. Is that seems to be the source that they're pitching, right?
Correct. But again, like every cloud provider seems to have that. The only thing that they have is access to GPUs, which is like saying that, hey, I know NVIDIA, so they're going to give me the GPUs, and that's my moat. But it's like saying with WeWork, it's like, hey, I want to lease every office space because in co-working, I want to be the one that can sublet the most amount of office space, which is great. But if you have 1,000 GPUs or access to 10,000 GPUs or access to the new generation, if the unit economics don't make sense, the more the GPUs, the bigger the problem. And that's what Benny and I have been discussing, is like, hey, like leverage can make any good investment look better, and then leverage makes any bad investment worse. And today we're looking at a problem where, hey, you have about 27 billion of debt right now. You have debt that there's about 13 to 15 billion left in capacity across all the lines of credit that they have and all the delayed draw term loan facilities. And it's like, okay, so you can build the CapEx out to fund your revenue backlog for the next 1 year, but then you're going to need more money to fund the CapEx again. And what's interesting is like you reach a state of steady state, like giving them credit for their growth. They have about 10 billion in targeted revenue for 2026. Even if you quadruple their revenue in steady state, take it to 40 billion bucks, because the unit economics don't work. The way it works is you reach steady state in, like, call it 4 to 5 years, and you turn cash flow positive. But today, the right way to look at this business is not EBITDA, it's EBIT. And once you put in EBIT, like, the margins are razor thin. And now you look at the cap stack, which is a 4 to 5 to 1 debt to equity ratio, your net cash flow is substantially negative. So you're negative when you make the CapEx, then you go negative, then you go positive for 1 year, and then in the year 7 you have to do the CapEx again, because this cash flow is not to perpetuity. And most of the larger firms, when you look at their analysis, the investment banks, and it's sad to see, is that they take the models to steady state. They'll show you that EBITDA positive year, and in that 1 year they apply an EV to EBITDA multiple. But an EV to EBITDA multiple assumes that the revenue goes in perpetuity, or that EBITDA goes in perpetuity. But this is not a revenue stream in perpetuity, because to generate that, you have to do the CapEx. So you have to normalize the EBITDA for the replacement CapEx based on the useful life of the GPU. And when you sensitize that across 4, 5, 6, 7 years, Michael Burry is more pessimistic, and he thinks it's 2 to 3 years. Hyperscalers underwrite 4 to 5 years. I'm saying let's underwrite 6 years. Let's even go by a more lenient standard, underwrite 7 years, 10% of residual value after 7 years. The business is not solvent.
Right. And I think that's the thing that, our viewers and people want to understand is, like, that is, we're talking, you by the way, Ameesh, you got the squirrel excited because he's lived his life in spreadsheets just like you, valuing assets. But, the reality is it's an equipment leasing business,
right?
And you have equipment. What's the value of the equipment? Or, like, how long is there value to it? And then, if you're going to be funding it, you have to, this is just math, right? Like, right?
This ain't ski rental, that's for certain. That used to be the best business in the mountains, right? You'd buy skis wholesale. They pay for themselves within 2 rentals, right? It's pure profit after that, right?
Yeah.
You could throw them in the skip after 2 seasons, right? This is the opposite.
This is the opposite, because exactly you hit the nail on the head. It takes 6 to 7 years for this business to pay itself off, and then you have to do it again. So you are at break even, and the issue, you are at a 2 to 3% IRR. And you can take Vera, like, you can phase up revenue numbers, being like, hey, Vera Rubin's probably going to give you a higher revenue per megawatt. Give all those assumptions, right? This takes, the life cycle of the chips is almost, it's probably lesser than what it takes to pay back the investment. And the investment is so large to provide this capacity that you take on debt for it, and that debt is expensive. So your IRR,
and that debt takes you out in the end. So yes. Neoclouds, they're not all equal in your eyes. You've got a slide ready here, haven't you?
Yeah, let's talk about that before we get deeper into CoreWeave, because I think some people don't understand that there's a difference between Nebius and CoreWeave. There's a difference between IRIN and CoreWeave. IRIN, by the way, in the squirrel's home of Australia, I actually remember looking at that thing when it was like a couple $1 stock, and someone was pitching it to me. It's been a good one, but maybe Ameesh, just kind of run, when you think about these different models, what is the difference that people need to understand between them? Without, you don't have to go into too much detail, but just a high level.
Absolutely. And this comes back to the first discussion that we had. They're fundamentally different businesses. Like how we like to finance the base layer and stay away from the chips. A lot of these companies provide the power in the shell, and they lease it out to either hyperscalers or neoclouds. So Applied Digital is a company that leases out the shell to companies like CoreWeave. In fact, CoreWeave is one of their biggest clients. Core Scientific has a power pipeline of, I think, about a couple of gigawatts. And they're all Bitcoin miners. They had the power. That's why, and power is a bottleneck, which is why that power became so valuable, and they all pivoted to being AI developers. But they're not buying GPUs. They're just providing the power, and then it's either a hyperscaler or a neocloud such as CoreWeave that comes in and and leases the space and provides the GPUs. Iron and Nebius are the exceptions from that list that you pulled out, in the sense that they have the power and the GPUs as well. It's a full end-to-end integrated stack that they're providing.
But talk to me because Iron and Nebius are, they're doing, at least in terms of equity prices, they appear to be performing a lot better than the likes of CoreWeave and Fermi, right? But they still have that GPU depreciation problem if they're in that game.
They do have they absolutely have the depreciation problem of the GPUs. What's interesting to note about Iron and Nebius is that they're building the power and the shell, and they are essentially buying the GPUs. So CoreWeave, on the other hand, is leasing the power and the shell from a developer. So he's passing on that margin, which is substantial, to the developer. And also, CoreWeave's leases, being a neocloud, they have to sign leases at a significantly higher premium for a developer to sign a lease with them versus a hyperscaler. And so that premium that CoreWeave pays to a developer, which is substantial, because a developer wants to earn more than the equity cost of capital. So like, he's solving for double-digit annual returns, and over a 6 to 7 year life, a developer is trying to double his money in that business. So like, once you that's the premium that Nebius and Iron are not paying. So I guess their unit economics are slightly better than CoreWeave. Also, Nebius and Iron have that asset, which is the power and the cooling, which is a much longer depreciation cycle, and they have the benefit of that as well, right? Because that's not going away. Power is valuable; it's going to remain there. So that's the fundamental disconnect. And
so I'm going to really paraphrase this, and it might be overly crude, but when I was looking at the CoreWeave IPO, 18 months ago, right? I was thinking the only reason this business exists is so that NVIDIA's got an alternate customer versus the hyperscalers who are eventually going to come for Jensen's margins, right? Is that it's in a purely efficient world, why would there be this kind of intermediary?
It's a distribution shelf, and that's all that there is for NVIDIA.
Yeah.
Now, NVIDIA needs many, many distribution shelves to get their product out. But at the end of the day, like NVIDIA can very easily just provide the GPUs to the hyperscalers as they do. This is just not a customer for NVIDIA. And a $2 billion investment that NVIDIA made in the company is nothing for NVIDIA to just get their GPUs out. And at the end of the day, like, CoreWeave doesn't provide the software services or run an AI model on their own GPUs. They lease the space out to either a frontier lab in bulk, or to a Microsoft, or to a hyperscaler. So what that does is for NVIDIA, they have more end users building on GPUs. So all that it is a distribution shelf and nothing else.
Which ultimately helps their margins, to the squirrel's point, though, right? Because Jensen's running these really fat margins. Me and you, the three of us, come up with something we try to sell to Costco or Walmart. They're going to beat the shit out of us on margins, right? Because they have the distribution. And so I think ultimately, and we can talk about this later, but the circularity and the concentration of this whole game makes it that you want as many guys out there as possible. So I think that when we think about the circular financing, you can't really blame Jensen for doing that, can you?
No, I think look, as a business owner, he's investing into a company to get his product out, and the net, he's also, the money that he's investing, it's kind of like a free option. It's like, hey, like, I've already gotten revenue more than 2 billion from it, and if this company takes off, then it's asymmetry for him, right? And you'd make the same, like, hey, like, I'm investing 2 billion in you at whatever XYZ valuation, doesn't matter, but you're giving me 2 billion back the same year in cash from the GPUs that I'm supplying to you. Now, I of course want your company to do well. If the company does well, my 2 billion becomes 10 billion. But if the company doesn't do well, I've gotten my money back. So I have no principal at risk, and I've gotten my product out.
Yeah, and we've seen this before. We saw this in the .com with Lucent and those guys like funding their customers. We're seeing it, to some extent now with Google funding and Anthropic, but they're going to have a 200 billion of cloud revenue. So this is I don't know.
It's kind of similar to get the product out, right? It's more about getting the GPU out. It's about having more customers hooked onto it. It's the same thing how Google and Amazon invested into Anthropic, and which is why Anthropic runs on TPUs. And even if you listen to Jensen's interview with Dwarkesh recently, he mentioned that, hey, like back then, NVIDIA did not have the kind of money to invest in an Anthropic. And because of that, Anthropic, which is, you could argue, the leading frontier lab in AI, is now being trained on Google TPUs because Google made that investment. And NVIDIA made that, they presumably could have been on GPUs. So yes, as a business owner, if you have the balance sheet to extend your moat, to have more customers hooked onto it, because at the end of the day, think about this, once customers are building on your GPU downstream, there's a high switching costs. So so that's another reason why NVIDIA wants as many customers, as many different names, as many distribution channels. But hey, is there a software value that these guys provide in the middleman? No, they're just taking the GPUs, putting them and giving it to someone. It's not a commodity that they have a moat on that someone else doesn't. And it's NVIDIA's choice who they decide to give it to and who they don't. Today, NVIDIA can decide that we don't want to give it to CoreWeave, we want to give it to Nebius. They can decide we just want to give it to Microsoft. The allocations are decided by NVIDIA.
Right. And so to kind of hammer a little bit, these guys were early, right? The Magnetar guys are smart guys. They gave them some money and they got in the game. These are former Ethereum miners. And so, to go back to what you said originally, there's supply and demand imbalance. They were there early. People came after them. That's why they're the biggest guys now. Correct. Is that a sustainable moat, or is that just, hey, right time, right place, hit it well, but over time, why do we need CoreWeave?
I guess there is no moat. There is no IP. There is no moat. They're just it's a levered bet on GPUs. It's like, hey, I know Jensen. I have a relationship because I was first man early. I have access to GPUs, which are in high demand. Now, that is not really a moat because that is something that you have a relationship with. That someone else can build the same relationship tomorrow. But the first mover, to your point, and coming back to the moat, is it's the same thing as WeWork. Co-working existed for a really long time. You had Regus, other companies globally, right? And they just came in and just beautified the product, applied better veneer, and we're hey, we have this. We're a technology company, and we have a community moat, and we have the software that links our community to other. What followed was several co-working companies try to rebrand themselves, etc., as software companies creating a community. No one talks about those companies anymore. They don't exist. And they had the same model being sign leases at any price. Landlords were extremely happy to sign leases with them because they were overpaying from the market. And which is the same thing is hey, today as a landlord who has a power in a shell, CoreWeave pays above market because they have this contracted backlog that they have to fulfill, which is all great. But I keep coming back to the same point is that, hey, you have 90 billion of revenue. Let's give you credit. You're going to grow. You're going to have 180 billion of revenue. But if the cost to generate that revenue is more than the revenue you generate, you're not a sustainable business. So it's not about is there an IP? Sure. If there was an IP, it's a different story, right? Anthropic, OpenAI, they have tremendous IPs. And I'm sure they're going to find ways to monetize those IPs. But without any IPs, it's simple math. I'm renting a GPU for so much. This is the cost. I'm buying a GPU for so much. A GPU depreciates in so many years. This is the rent that I get from it. And when you do that math, it doesn't add up.
Just Ameesh, I totally get it on the WeWork analogy. Let's just expand again to the broader neocloud universe. And our friend of the show, Tom, who is a power trader, always says
who Ameesh has actually met.
Oh, right. Never bet against engineers. Now, so these other neoclouds that have a moat in the form of power, right? The
yeah.
engineers are going to reduce the physics of and power requirements and cooling requirements of these data centers over time. Is there moat erosion from that aspect?
I think as it relates to power, sure. Like when you look at the new generations of GPUs that keep coming out, which are measured in the throughput or the floating the flops, and which all boils down to, hey, like what is the cost of inference, what is the cost per token, which all boils down to per megawatt, right? And that's what I said is the defining metric. The thing with power is that today, even if there are pockets that may have power, the grid is backed up and you can't build a grid overnight. So like even if there's efficiencies in power, which there will be, there's still enough demand for these data centers in the right markets to overcompensate for even efficiencies in power, if you know what I mean.
No, that's very clear.
And for that reason, like most of the larger data centers now are have on-site generation. It is something that we call behind the meter. And we look at financing some of those as well, because we truly think power is something that is that's more valuable commodity than ever before right now. And any improvements in power efficiency, the way the curve looks right now, is compensated for the excessive demand. Now, sure, if there's a slowdown in demand, the equation can change. But for now, we think that that bottleneck is real.
Okay, and that the market appears to be sniffing that out, right?
Right.
The captive power plays are definitely, so the former Bitcoin miners that have cornered a power supply angle definitely have an edge still.
It's the right place at the right time, and we've seen this like even across the deals that we try to get involved with, is that, hey, like the power backlog for the deals that don't have power is yours, and it's speculative, and like we try to shy away from them. So like if you have power in hand, it's gold.
Let's talk about that, because those power backlog guys are probably they're still at the blueprint stage of their operations, right? And I came across this amazing statistic via Ben Hunt the other day. That this was 50% of US citizens wouldn't want to live next door to a nuclear power plant. The number for an AI data center is 70%, right? Which is kind of phenomenal. And if you haven't got your power, if you haven't got your permitting, that's just going to be a tougher and tougher ask for all of these guys.
Yeah, exactly. It's going to get harder. It's not going to get easier, which is the reason why like you can see a lot of these Bitcoin miners and the list that Ben pulled out earlier with Applied Digital, TeraWolf, and a lot of those companies that, hey, the market's valuing a very scarce commodity. Is it disconnected from fundamentals? Is market pricing perfect execution of all those data centers being built in 5 years? Sure. But they're pricing a commodity like a rare earth that is extremely valuable and is going to be valuable for the foreseeable future.
Yeah, so it's a tough short, right? Even if they've got Mickey Mouse valuations or crazy valuations, ultimately at what price that scarcity right now, it's really tough.
Right, you can't price that risk.
So let's get back to CoreWeave, and let's get into what the squirrel loves to talk about, which is the capital markets, right? So let me pull this slide up real quick. You have this perpetual motion machine as, okay, on paper it looks like they're growing, and Ameesh and I both were looking at some of the major banks' models. They're not really thinking about it the way they should be thinking about it. And so, Ameesh, why don't you go into this concept of like it works in a good capital market state, and how if we get into a fragile capital market state, that's where the trouble can begin.
Right, because these guys are chasing growth at any cost, and the cost per megawatt for the older generations were about 34 million, and for the newer generations, as they roll out Vera Rubin, like those costs are closer to 40 million. And to fund these CapExes, I mean, they kind of, like I said, have 27 billion drawn right now across various facilities. They have, availability of another 15 billion, but based on their own growth trajectory, that takes them to like end of 2027. That's their own growth trajectory. Now, some of the debt comes due. What happens when you have to refi the debt that comes due, and at the same time, you have to issue more credit to keep your growth in line with your revenue backlog? So it's kind of like a cycle wherein it's a debt spiral, because you have debt and you have more debt, and you have debt that's refinancing old debt. You have debt that's financing more CapEx, but you're financing more and more CapEx that has bad return on investment economics. So what happens is, like, yes, you can keep you can keep it going as long as the capital markets keep giving you money. But the question is, like, the last ones holding the bags are the ones that are going to be left with assets that are not worth anywhere close to what they're marked on the books.
Okay, so let's talk about the credit capital markets. How much differentiation are we seeing in terms of data center credit pricing across the market?
So, it's like I said, it's a world of have and have nots, and when you look at the hyperscalers, like they price their investment grade, they price in the range of 200s over SOFR. The neoclouds tend to price in the 400s over SOFR. But the neoclouds, because it's not hard to see the reality that we're discussing, have not been easy to finance recently, and because of which they've had to hit the bond markets, which are wide open and plentiful and super liquid right now. But like, how long are they going to be liquid? We just don't know.
Yeah, I mean, we saw a CoreWeave junk bond deal yesterday, right?
Like at 7.5%, and that's kind of interesting. Also, like, there's nitty-gritties in these loans. Like when you look at CoreWeave, and this is again something that's very worrisome, is that they have different tranches of debt. There are certain revolvers at the corporate level, and then there's debt at an SPE level. And there's debt at SPE level, which is secured by the underlying contracts and the underlying GPUs. So like, let's say there's 40 billion of revenue that's supposed to come from these three sites. That revenue is not even like before it even hits the parent, is being collateralized by the debt in those SPEs and the GPUs. And the way those loans are written is that they're depreciating loans back to the life cycle of the GPU. So the GPU life cycle is 4 to 5 years. Like, these loans are written for like less than 5 years. So the loans get paid back and they have the GPUs. But like, what happens to the senior creditors at the corporate level?
And these are senior unsecured at the corporate, right?
Exactly. Those are the ones that are really concerning. And like, they're pledging the GPUs, they're pledging the contracts, underlying contracts in those SPEs, and then you have revolvers at the corporate level. So everything is levered to the hilt. You need the capital markets to be fully open and wide open like they are. Any jam in the capital markets is could cause major problems across the stack.
How much neocloud debt is in the high yield index at the moment?
Like in aggregate?
Yeah.
Couldn't tell you, but I would say, it's substantial. Like
material. Is it material though?
It is material. It is material. It's getting more material, and but there's appetite right now. There's appetite, and there's products that are being developed for insurance companies. Insurance companies are buying this paper. There's global appetite for it. And look, the hyperscaler credit, it's investment grade, et cetera, and it seems to be very different than neocloud credit. But the junk bond markets, it's wide open until, because and the reason why it's open is it's kind of reflexive, right? Because you're having more offerings, take out other offerings to keep it going, and you somehow start like it's again the way the paper is being rated and getting done is that, hey, I have an underlying contract with Meta, or I have an underlying contract with Google, and they underwrite the off-taker.
Yeah.
From those off-takers, right? And that's how these papers are getting written. So like the whole concept was, there was this company, FluidStack. FluidStack was again a way for Google to push their TPUs, and Google was guaranteeing the payments if you had FluidStack as a lease, as a tenant. But Google stopped doing that. So once Google's like, hey, we'll have an offtake from you, but we're not going to guarantee your lease payments. We're just going to stop doing that. They were doing that to push their TPUs. But at the end of the day, like, these are all sort of mechanisms for the market to make neoclouds financeable. And the market's kind of caught up to it now. And today, for neoclouds, when you don't have an offtake agreement with no termination rights from a hyperscaler, or you don't have a credit wrapper, and credit wrappers are less and less getting less popular for the hyperscalers. They've stopped doing that.
This is a credit wrapper would be written by a hyperscaler.
It'll be written by it's like guaranteeing the leases of the tenant. And
yes, exactly. Yeah.
From that now, so the market's kind of getting. I would say that even though there's appetite today, like the trajectory and the market's catching up to some of the issues with these neoclouds, and it's totally codependent on offtake agreements from the hyperscalers. So as soon as a hyperscaler was to pull back or cancel a contract, that has a domino effect on, the entire industry.
Fascinating. And
Squirrel, let me just stop you for a second.
Yeah,
Ameesh, the Squirrel and I were talking, and I talked with you when we talked about this Google deal, and like there's different, speculation, and you don't need to speculate on it. But one of the thesis was, maybe the credit market, the private credit market, which has been a big driver, is getting a little tighter. And I know you're, involved with these guys, and the fact that CoreWeave had to go to the bond market, the junk bond market, maybe there's going to be more of that because those guys aren't coming or going to be as much of a driver, because you see all these redemptions. I mean, even yesterday, Cliffwater 17% redemption. What's your thought on the role of private credit in all this?
Private credit, obviously, I mean, the ones that have software exposure is kind of concerning, right? And again, it's hard to underwrite private credit platforms because the NAVs are really dictated by them, and like if you don't know the underlying loans, you're really relying on the information that they provide, and the marks are not nearly as real as what they should be. But clearly, like, I would say like there's concerning loans that have been written that we see all the time in the data center space. These are loans that probably shouldn't have, like they're money bad today. It's not when the cycle corrects. And like senior lending is a business where you have limited upside, so you have absolutely no appetite for risk. But like you're seeing loans go up to like 95% of LTC, but at that point, just be the equity, guys. Like, what is the credit enhancement of 5% going to get you? And we're seeing like those kind of things being done and priced very, very tight, where the risk return doesn't make sense. So as it relates to, the inherent problem that private credit might have with software and other stuff, like I don't want to speculate or comment on that. But I think with data centers, like we're seeing like, like when there's this like a lot of capital that has been raised by a lot of these AUM guys, and they find a new strategy to deploy it, like, are these certain deals loans should be written? Should these deals be financed? But I think that, as there's more capital that flows into it, as the industry starts to mature, I don't think it's close to maturity yet. Like there is, people really starting to ask the right questions, and really, there's deals, and there's sponsors, and there's tenants that are sort of becoming like, hey, financeable versus non-financeable, and we're starting to go there, and that's why you're seeing like a lot of, the junk bond offerings, because those guys don't know what they're buying. Like these are not sophisticated lenders who are underwriting the assets, underwriting the companies. They're looking at the rating. They're bond traders. They're buying these bonds. They have no idea what they're financing, which is not too different from 07, 08. which is what
Yeah.
is scary. It's just that the numbers are much bigger this time.
This is the parallel, and I think that's where we should go with the last 10 minutes. And this is the thesis that I'm really excited about, the work that you two have been doing on this. And I think this could have real legs. Benny, why don't you frame it with Amish first?
I mean, yeah, so it's just one of those things where we have, we talked about the Magnetar trade, right? And how what they did in 07. So for everyone who doesn't know Magnetar, they're very smart guys, and they had basically kept the CDO market going for an extra 18 months, 24 months by buying the equity of the CDOs and then owning the senior tranche and then buying a mispriced CDS.
If it wasn't for Magnetar, the Big Short movie would have never been made, because there wouldn't have been characters like Barry and the Front Point guys tearing their hair out.
Or Steve Eisman or any of them.
Absolutely. Yeah, exactly.
And so I think that's where it comes down to is like, Google's funding because they're getting the money. Magnetar, which is literally the largest shareholder of CoreWeave, again. And and so do we think that there's an aspect of that of, when you think about it from just an underwriting standpoint, forget about CoreWeave for a second, you're like, hey, like how a factoring guy would be like, oh, I got a Walmart offtake agreement for your product. Do you think that's what's introducing a lot of this capital, and then is like creating the ability of like people not realizing it, they doing bad underwriting, and we're just getting too much capital chasing something that people maybe don't understand?
I think there's too much capital chasing something that people don't understand. And the question is that the aggregate capital that is being spent, right? There's definitely going to be winners and losers, but is it a net positive or net negative? We don't know. We don't know that as well. And you're seeing like a lot of capital also just, there's how the baby gets thrown out with the bathwater. This is the opposite. There's like bad deals getting funded that are going up in value purely beta driven by the market and capital markets, buoyed purely by them. And I think a lot of the paper is being sold globally, insurance companies, securities firms, every desk in Asia, every desk in Europe, and like they have no idea what they're buying.
Sounds a lot like 07, 08, doesn't it, Rupert?
Belgian dentists backing up the truck.
Look, it's funny. I was at a members club in New York this weekend, and like there was a girl who was talking to me about TSMC options, and that's when like, hey guys,
that's the 2026 version of the shoeshine boy, basically, from
absolutely
the last 1920s. 100 years later,
the option trading influencer.
Yeah.
But I think that's a good point. And one of the things Ameesh and I talked about is even within the hedge fund community and investment analysis community, they're not really they don't know what they're underwriting, right? Like this, like when we think about the stocks that have done really well lately, these picks and shovels, like phosphates and some of these, like, I would bet there's not a lot of guys who can actually explain to you what ASML does. Probably one of the most complicated things in the world that is central to the global economy. And so, Ameesh, what do you think that fragility is one of those things where people are okay while it's working, and then when it stops working, there's a reflexive dynamic, like we're getting out of here quick type of thing?
Yeah, absolutely. And also, it's also like an incentive alignment thing that you and I spoke about. People are like short-minded. They're looking at earnings today. They're looking at management guidance for earnings for a couple of quarters ahead, and they're underwriting those, and they're applying historic multiple, median multiple, and they're justifying their investment. And they're probably not going to get fired if they lose money, by investing in some of these AI names. But like at the end of the day, it's like when you're investing in a business, one, you really want to understand the business. You want to understand pricing power. You want to understand durability of the moat over an extended duration. Can you draw a DCF of these companies for 10 years, apply a reasonable discount rate, and value the business? Do you understand how this business really works and how is it different from a competitor? And the question is, like, most people don't, right? Because like today, When you look at a photonics company, if you're investing in a Lumentum, or if you're investing in Core Optical, or if you're investing in SK Hynix, or you're investing in CoreWeave, they're completely different businesses. So like a semiconductor analyst cannot cover those businesses because they're very fundamentally different. There's certain businesses that are better on technology. There's certain businesses that are better on infrastructure. There are certain businesses that are just a leasing business like CoreWeave. And like, and we've seen a lot of the analysis from some of the large investment banks, and like, man, you've seen how shoddy that work is. It's like no one's really drilling down the single most important multiple in the single most important input. For example, in CoreWeave is the depreciation cycle of a GPU. And if that defines how much CapEx you have to do every 4 years, 5 years, 6 years, how can you just apply a multiple on EBITDA? And how can you show the depreciation but don't take it into account in coming up with a share price? And like, that's the level.
Make DCF great again.
Yeah. and you know,
I said the banker.
they make the DCFs, but they have they're not interested in underwriting the business or understanding the business. And we're seeing this across the board.
And I think that that's actually just, there's a big gap in my mind of the perception of reality versus just the positioning in the market. And
Right.
I think that you don't get that gap to be wide that often. You know, I've been doing this for 20 some years, and Rupert's been doing it since 1994. And we've seen a couple of these instances, they occur, but it's usually based on a gap between perception and reality. And then, you know, incentives, right? If you're a pod shop, like you said, 1 to 3 quarters is all you care about. You're just going with the momentum. The trend followers and the passive guys have taken over a huge amount of share. And then in lending, you know, you guys can correct me if I'm wrong, but most bankers just care about generating fees, right? They're like, get the deal out the door.
Right. Absolutely. And by the way, especially with high yield, because like they're not retaining any risk. Like they're just in it for the fees. So this is being sold across, and like there's no risk retention. Like it has many parallels to like 2007, 2008, and like I wouldn't be surprised if the same bankers, if they're retaining risk, are buying CDSs, or different desks in the banks are buying CDSs against some of these companies that they're financing.
So I guess the final thing we'll end the show with is, how do we think this plays out? Like you know, me and you, and I think Rupert is on board with us, is we think CoreWeave doesn't have much economic value, and it has debt spiral tendencies, let's say. Yeah. What is it that gets us from here to the market realizing what we're thinking?
I think, and again, like, you know, the future is unpredictable, right?
Yeah, of course.
All we can seek is asymmetry in our investments, and which is why going against the market, your math can be right, but you can still completely lose your short. And that's why we've always been cautious of that. But like, I think, you know, the market's so fragile right now because, as you pointed out, there's such a big difference between reality and perception that any external event can lead to, can act as a catalyst. Like we saw that with the Iran war earlier in the year. We saw that with tariffs like last year. And like, even if it's not directly correlated, because there's so much, the values are so inflated that any small catalyst could potentially be a canary in the coal mine. And it does not have to be directly correlated to CoreWeave or any of these names.
Yeah, and I think that's a great point. And our friend of the show, David Dredge, who's, you know, world-renowned volatility guy, he likes to say, I don't predict, but I look for the things where it only takes a guy throwing his cigarette out in the forest, and there's a lot of built-up brush. And I think we can all kind of agree there's a lot of built-up brush, and it seems to be building still at a pretty intense clip. And so when we think about CoreWeave, it's one of the things that no one cares that CoreWeave is around in 5 years, right? It's not like I'm saying short Google or something. I think we're saying that, hey, this is a business that was the right time, right place, and now it's getting more fragile, and it's underwritten by guys who played this game before. Let's put it that way.
And they already got their money at X many times.
Well, no, they're still long the stock, but I would imagine that they're structured where they're okay.
I imagine they'll still have a piece of the stock when it goes to zero.
I think they will. Right? I would agree.
Yeah, and they're not going to be too fussed about it. They sold
All right.
calls
Well,
against it.
go ahead, Rupert.
Yeah, no, listen, Ameesh, that was absolutely fascinating. We're going to do this again for sure. Thank you for all of the work that you've been crunching with Benny over the past couple of weeks. I know he's been a hard taskmaster, but you know, we're going to watch this space really closely. We've got massive sort of headline risk around sort of big AI IPOs right now, but you know, these little corners of the market, you've got to keep a close eye on.
No, absolutely. It'll be interesting to see, Benny, to your point as to what is a catalyst. What happens when the lockup for SpaceX, Cerberus?
There is no lockup. There is no lockup on SpaceX. Let's be honest, right? The insiders, ex Elon, are free kind of within 2 weeks, right? This is the slight supply dynamics around that deal are intense, but we've talked about that a lot.
Well, and I think that's just to continue this for a second. You know, during the show, somebody sent me a year-over-year, so the first derivative of the CapEx growth, and it's peaking out right now based on Goldman's numbers. And I got to tell you, Ameesh and I have been talking about this, and we're like, hey, 750 billion of hyperscaler CapEx this year, and there's no free cash flow, and obviously Google's doing an equity deal, so you know, and as you guys know, I told the squirrel on Sunday, I was like, don't be surprised if we start seeing Meg 7 equity deals, and then boom, the next day we saw the largest ever.
I said that would be a disaster. 48 hours later.
But I guess what my point is, when I see Google doing that, and then we see, you know, Open or SpaceX coming, OpenAI coming, Anthropic coming, they're not dumb. Like, right? Like there's a reason why this is all coming right now, in my opinion. Like they didn't just like magically all say, oh, let's do it at the exact same time.
Markets are open right now. And I think the credit markets are the catalyst that made this and could break this. And they're not open. They're open today. They're open tomorrow. They might not be open day after. And we've seen this before.
And I think that's the great takeaway from this whole conversation is that, hey, you know, what the price is telling you today is the price based on the state we're in. And right now it's an open credit market or open capital market state. But when we transition into a closed capital market state, things are different. And so what we're talking about is find the stuff that is either to be long, the most robust, or to be short, the most fragile, basically.
Right.
Yeah.
Yep.
Yeah, it's a perfect way to end. Ameesh, thanks so much. Benny, anything to close on?
Yeah, just Ameesh, just, you know, if you want to finalize where people can find you and, you know, your little like blib on your firm and stuff.
Yeah, no, Ben and Squirrel, thanks for having me. And look, we're long AI. We're based in New York. We're long AI infrastructure. We just want to warn people to watch out for certain inflated valuations, the haves and have-nots. And you know, Ben has my email. Ben, you can share it after the show, and feel free to reach out to me for any questions or any discussions. We're always, you know, open to discussing counter arguments or any different perspectives, and you know, trying to improve our own learning of the industry.
Mate, that's absolutely fantastic. I've learned a ton. Thank you.
Awesome.
Okay.
Thanks, buddy.
Ameesh, Benny, and the squirrel out.